Welcome back. Congressional leaders are hoping to at least get an outline of a debt deal in place before the Asian markets open up, and the first of them begins trading at about 5 p.m. Eastern time. What happens if nothing significant is hammered out before then? Joining us now is Rich DeSalvo, former managing director of Morgan Stanley. Rich, thanks for being with us.
My pleasure.
How do you think the markets will react if there's no deal?
I think they will react, but they won't overreact. I think a perfect example of that, we've all heard about Asia. As you mentioned, the trades are coming very soon, or trading is opening, Greg.
Yeah.
Take a look at this, that on Friday alone, because they thought a deal was going to get done, the markets jumped 2.1% on the Hang Seng, which is the Chinese stock exchange.
Right.
So I think because of that, what you'll see is if nothing does happen, you might see that pull back. So I'll call it a sell-off a little bit,
right.
But then I think you'll see some normalcy.
If the markets really thought that there was a debt default crisis here, why would the Treasury 10-year be so low at about 3%? Yeah. Wouldn't it be higher?
Absolutely. You bring up a very interesting point. I'll tell it to you this way. Last week, $28 billion in Treasuries were sold. The interest rate, 0.005. So that in terms of dollars, every $1 million, that's $50 of interest.
But you know, Tim Geithner keeps saying it over and over again. I'll quote his latest quote: "Failure to raise the limit would precipitate a default by the United States." I'm not sure that's true, and here's why. I crunched the numbers. We'll put it up on the screen right now. This is revenue less costs on a monthly basis. Now look at that. Your debt interest payment is $29 billion. Social Security, Medicare and Medicaid, $50 billion. Active military pay, Veterans Affairs programs, about $3 billion each. Now you total that up. Go to the next page. Total cost there is $134 billion, but you've got revenue each month of $200 billion. You got $66 billion left over. So there's no reason to default on our debt, is there?
No, there isn't. In fact, I will tell you, default's a strong word. Remember, too, that, for example, Social Security payments actually can accrue. They don't have to default. I could actually pay them a couple months later, right? So therefore, I will tell you, if this credit worthiness, we think that's a big deal, and the S&P is doing some things, I'll tell you, I don't think it's as big a deal as people think it is. I actually think it's more a negotiation ploy to try to make some things happen a little faster in the spirit of getting a deal done.
All right, we've missed the debt ceiling 3 times in the last 30 years, 85, 95, 2002. 95 is very instructive. Then Treasury Secretary Bob Rubin said, the bond market will be impaired for 20 years. Well, guess what? We missed the debt ceiling and didn't raise it for 5 long months. And not only did the markets really not react, but the impasse was followed by balanced budgets and a huge growth in our economy. So maybe history teaches us that this isn't such a big deal.
It's not. Understand something, that the debt, since the early 1960s, the debt ceiling has raised, first of all, 74 times. So it's not as if we're saying no to the current administration. We're saying no to the way the spending is going on. There's a big difference. And I'm going to continue that. And you made a comment earlier about the economy and about interest rates in terms of what's happening. Understand, why is it that countries such as China and Japan, who now have $2 trillion, Greg, $2 trillion of our debt, why is it that they're happy to buy at really zero interest?
Right.
Well, they're buying the country, they're buying the economy, and they're buying world leadership. They're not buying the Treasury's performance, they're buying our country's performance.
Yeah. Legendary investor Stanley Druckenmiller told the Wall Street Journal, he rarely gives interviews, but he said, quote, "It's not going to be catastrophic if we miss the deadline." He says the bigger danger than a technical default is raising the debt ceiling without any conditions to control spending. He's right, isn't he?
He is right. And I'm going to take that further. What is it that Wall Street really wants? Wall Street doesn't need answers. They want clarity.
Right.
Show some clarity, show some framework, and then I think we'll be fine.
All right. Rich DeSalvo, former managing director of Morgan Stanley. Great to have you with us.
Thank you.
Thank you.
All right, Greg.